Okay, so we have part 1 of our AR sales study guide lecture. Which of the following is an account that is not affected by the sales cycle? The sales and collections, accounts payable. That has nothing to do with sales or collections of AR. Number 3, the overall objective in the audit of the sales and collection cycle is to evaluate whether the account balances affected by the cycle are fairly presented in accordance with accounting standards. Yes, that's what we're after, to make sure that sales and collections are properly stated and accounted for properly. What event initiates a transaction in the sales and collection cycle? A request for goods. That's what's going to initiate the process. Somebody requests the goods. So the customer would have usually a customer order first is the initial exchange, and that turns into the sales order. So again, that's what would initiate the whole sales and collection cycle, is the initial request, which usually comes from a customer order. So then number 3, a customer order is a document that indicates a request for the merchandise. So the initial request is through the customer order, and that turns into the sales order. And number 5, the critical event. What critical event must take place before goods can be shipped in order to assure payment can be reasonably assured? This is the credit approval. So companies have credit departments that look at the credit history, almost like you're buying a house or a car. They're going to do a credit check on you personally. When a business wants to interact with customers, they should be doing credit checks to make sure that these companies are financially stable to pay the bill. So this is an important thing from an audit standpoint, to understand what the process is. Are they looking for credit approval for their customers? Because if they aren't, that is a control issue, because if they're issuing product to customers that don't have good credit, it's less likely that the customers are going to make the payment, more likely that they're going to have a higher amount of bad debt, and therefore should increase the amount of allowance that you set up if they're not doing this very important step of the process. And number 7, a document prepared to initiate shipment of a good sold by an independent shipper is the bill of lading. This is terminology, it's bill of lading. I've worked for companies, and every single company is using this term bill of lading to initiate the shipment of goods by an independent shipper. So this is coming from other shipping companies. Number 8, the document used to indicate to the customer the amount of sale and payment due date is obviously the invoice. This one should be pretty normal terminology for you. Number 10, most companies recognize sales revenue when goods are shipped. You'll see a problem in the inventory chapter where I'm talking about FOB, shipping point, and destination. So you have to be very careful that you understand those terms, FOB, shipping point, destination. We'll review it in the inventory section. But that is when you're going to initiate the sales revenue. At that time, the goods are shipped, depending on the destination or dock. Number 12, the total of the individual account balances in the accounts receivable subsidiary ledger should equal the balance of the accounts receivable in the general journal. So when you're doing your tracing, when you were looking at the AR subrecord, which was the AR aging report, that's the AR subledger, what did you agree that to? You agreed it to the trial balance, which is the general ledger, right? I mean, it's all coming from the same system. You're testing that general ledger balance. Number 15, the document that accompanies the customer's payment is the remittance advice. So, usually when you're paying your bills, right, and you rip off that little extra sheet at the bottom and remit it with your check to pay for your cell phone or whatever you're paying, that's what you call a remittance advice. Number 16, the document that requires adjustments to the customer's subsidiary ledger account is the credit memo. So if a customer is returning something and you're going to issue them a credit memo, this would need to adjust your subsidiary ledger because they don't owe you the money any longer, so it would adjust on that AR aging report. Number 18, Again, the bill of lading is the contract between a carrier and the seller of the goods that dictates the documents of the details of the shipping. Number 19, some companies have customers send payments directly to an address maintained by the bank. This is called a lockbox system. Many companies have this. We were just on the Yankee Candle tour and they were talking about their lockboxes where, their customers like Bed Bath & Beyond or the Hallmark store, they're shipping their goods to the Hallmark store and Bed Bath & Beyond. Bed Bath & Beyond has to send in their payments. They're sending them to this lockbox that the bank controls. So, wherever it is, there's a box that the payments get sent to. And a lot of your payments, when you're making payments to companies, you're actually sending it to the lockbox, not to the actual company. And then the bank controls the cash. This is a really good procedure to have in place to avoid cash handling internally. So it's really a good segregation of duties to have a lockbox because it's going to a complete third party and the ability to steal the cash is less likely when it's in third-party hands. Number 23, credit memos are normally issued to adjust the customer's balance to the amount owed to the company because of return of goods or an allowance. So again, the credit memo, when you issue a credit memo, it will reduce the amount that the company owes, and sometimes in this credit format. Number 25, when processing and recording cash receipts, an important factor to consider is the possibility of theft, right? So cash receipts, when you're actually getting cash sent to your company, the biggest risk there is that somebody's going to steal it. Number 28, you're an audit manager for Rogers & Co. and have recently taken on a new client, a manufacturing company. You're in the initial stages of planning the audit and you've decided to start gathering information about the sales collection cycle of the business. List below the classes of transactions that you need to gather audit evidence for in designing your audit procedures. The 5 classes of transaction that comprise the sale and collection cycle are the sales, make the sale, cash receipts, you're getting the money, sales returns and allowances. If there are returns, how do you account for those? Setting up a proper allowance. Then you have to consider writing off any of the bad accounts and then what your bad debt expense will be. So it's important that you understand this cycle because it clearly has played into what you've seen in your audit case. Customer billings is a crucial process of which auditors need to understand what are the most important aspects of billing. So how are you billing a client? To make sure that all shipments have been billed. So you're concerned that if a shipment has been made, has it been billed? Right? The billing is really what's generating the revenue or the sale. So to make sure that's complete, that no shipment has been billed more than once. Right? If you keep billing for multiple shipments, you can have overstatement of revenue. So the occurrence, how many times is something being billed? And that each shipment is billed in the proper amount. So if something's wrong in the system and it's overbilling clients, it's going to kind of get caught up with itself, but what if it doesn't get corrected until after the audit's done and you've got a huge over or understatement of your sales or your accounts receivable? So is the amount accurate? Now here is a bunch of terminology you can read. Talked about a lot of these, so be familiar with those concepts. Number 1, when designing audit procedures, tracing of source documents to the customer's subsidiary ledger and subsequently to the general ledger is done to satisfy completeness. As we talked about that. Number 8, in determining the level of audit efficiency, once the auditor has identified the key internal controls and identified any deficiencies in order to determine the level of control risk appropriate for a private company client, it is appropriate to decide whether substantive tests can be reduced significant or sufficiently to justify cost of performing test of controls. So you've got to get this done. You've got to get this squared away. Again, if you are going to perform a test of controls, that costs a lot of money to do, Can you reduce your amount of substantive audit testing? Right? There's an inverse relationship. If you do more substantive testing, you're not going to be doing a control audit usually. And for the public companies, if you're relying and testing on these internal controls, you are able to reduce the amount of substantive testing that you would do. So number 13, in many audits of sales transactions, substantive tests of transactions can be reduced in determining the completeness objective because overstatements of assets and income are of greater concern than understatement. So you're not as concerned that something isn't recorded per se. It's still on your radar, it's still an issue if that's the case, but the concern is that you've overstated something, that the invoice values are too high, that you're booking sales that haven't actually happened. This is of great concern because customers want or your client wants the balance sheet to look strong. So the more the assets, the better. We've talked about liabilities. Understatement is the issue because you want your liabilities to look less to have a stronger balance sheet. Revenue has a concern for overstatement. You want a higher profit in the end. So you'd overstate your revenue when on the expense side, the concern would be understatement. So please have that down too of how that all works. To determine that sales are accurately recorded, the unit prices on the duplicate sales invoices are normally compared with an approved master price list. So with the price testing that you performed for inventory, there's usually a master list there too of the prices that have been approved to purchase inventory at. There's also a master list of sale prices that have been approved by the CFO or possibly even up to the board of directors. That would say, we're going to sell this product at $10 per bottle, say for your cologne company. You would match the invoice that you've actually sold to the customer that the customer is paying back to that master statement. So all of a sudden, if on the sales invoice you start seeing that the sale was actually for $12, but the approved master file is only for $10, well, why is there a difference? Why is it selling for $12 when it was only approved to sell for $10? Is somebody in, the sales department gaining access to the system to increase their sales number? Is the CFO trying to manipulate the data to have higher sales in the period because his bonus is linked to sales? I don't know. But the master file would be, an independent party outside of the whole who would benefit from higher sales. So that's a good test to be testing the prices on the sales invoice back to that approved master price list. Number 17, tracing tests are for omitted transactions, while vouching are for non-existent transactions. So when you're thinking about the accounts receivable or sales. Now for number 5, sales return and allowances are often ignored by auditors because they are often immaterial. So that's true. The returns and allowance, sometimes they're so small that you're not concerned about it, but for the size of a lot of your clients, it should be considered. Number 1, when an employee who is authorized to make customer entries in the accounts receivable subsidiary ledger purposely enters cash received in the wrong customer's account, that could be an example of lapping. So we've talked about lapping, where somebody's taking money from one and then when the money comes in, putting it in the other account so they continually kind of have cash in their pocket throughout this process. Number 2, an audit procedure that compares the name, amount, and date shown on remittance advices, either paper or electronic, with cash receipts, journal entries, and with related duplicate deposit slips would be able to detect this lapping. So with that remittance advice, if you see that, Jane Smith made the payment, well, you want to see Jane Smith's account having a credit towards it that they've made a payment. If you don't see it on her account, where was it applied to? Maybe it was applied to the different account, and that would be a red flag for lapping. To prevent fraud, management should deny cash access to anyone responsible for opening mail. So that would be okay for people who are opening mail to have access to cash. Somebody has to open it. Entering sales transactions, yes. Whoever is entering the sales transaction should not be receiving the cash by any means. They could be deleting sales. They could be intentionally not entering the sale, but somehow still invoicing the client. Entering cash receipts transactions. So again, taking that control away from the person who's entering the cash receipts transactions, because definitely lapping could occur here if the person entering the receipts is getting the cash and applying it to different accounts. So number 8, which of the following would offer the best protection for a company that wishes to prevent a reoccurrence of previously detecting lapping problems with trade receivables? This would be a great one. Have the customers just send directly to the company's depository bank, so that lockbox. So I want you to understand number 11, what lapping means, and the internal control deficiency that allows it to occur. So here's an example. Please read through that. And then number 13, in planning the audit, an auditor can take 3 basic steps in determining the audit procedures to be performed for any business cycle or class or transactions in order to gain audit effective evidence concerning possible misstatements due to error or fraud. Lists those 3 basic steps. To design, test controls, and substantive transactions. So you have to understand those key controls. You would test the controls to reduce this control risk, and then you would design substantive tests for the monetary misstatements. Lastly, number 1, the auditor's primary concern in performing audit procedures of the write-off of uncollectible accounts relates to the risk that the client write-offs customer accounts that have already been collected. The primary concern is preventing the fraud of examining the uncollectible account authorization form. So what could happen here? Somebody has access to write off the uncollectible accounts, but they've actually already received the cash. They can pocket the cash and just say it's a write-off.